Have you ever heard of the phrase, the holy grail of financial planning? It refers to any investment that gives you a tax deduction on the front end, allows your money to grow tax-free, and then allows you to take your money out tax-free. This is a triple tax benefit that can only be found in two places in the IRS tax code. The first way to experience this triple tax benefit is by using the standard deduction to offset any tax on your required minimum distributions from your IRA in retirement. You put money into your IRA, got a tax deduction for doing so, you didn't pay any tax as your money grew, and then you use your standard deduction to take your RMDs out 100% tax-free. Pretty cool stuff. The second way to experience that holy grail of financial planning is to contribute to a health savings account, or HSA. A health savings account is a little gem in the IRS tax code that likewise allows you to get a tax deduction upon contribution, allows your money to grow tax-free, and then allows you to take tax-free distributions when you spend it on qualified healthcare expenses. Let me give you a quick example of why this is such a big deal. Let's say you don't have an HSA and you're using after-tax earnings to pay for your medical expenses. Assuming you're paying 25% effective tax rates, you'd have to earn $4,000 to then be able to spend $3,000 on your healthcare expenses. If you instead contributed that $4,000 to your HSA, you could then spend the full $4,000 on those qualified medical expenses. So you're essentially getting the federal government to subsidize your medical expenses to the tune of $1,000 in that scenario. And the more you contribute, the more they subsidize. Seems like a pretty sweet deal. It truly is the holy grail of financial planning. The problem is most people are using their health savings accounts all wrong. You have to remember that HSAs have that triple tax advantage. Tax-deductible contributions, tax-free growth, and tax-free distributions when you pay for qualified healthcare expenses. The problem is most people only take advantage of two of the three tax benefits. They get the deduction on the front end for the contribution, but then they immediately turn around and take a tax-free distribution to pay for qualified healthcare expenses. By doing this, they aren't able to take advantage of the tax-free growth in these accounts between now and when they retire. Because your contributions to your health savings account are invested in mutual funds, you have the ability to grow and compound those dollars in a tax-free way over long periods of time. Health savings accounts are designed to give you a tax-free rate of return. But if you take the money out before it has a chance to build a head of steam, you never really get to take advantage of all that tax-free growth. If you utilize your HSA in a slightly different way, you could build a huge tax-free nest egg between now and when you really are going to need all that money, which is in retirement. Instead of using your HSA as a slush fund for healthcare while you're young and not experiencing a lot of really intense medical expenses, you might consider paying your short-term medical expenses out of pocket with your after-tax earnings. Let those precious tax-free dollars inside the HSA grow tax-free between now and when you retire, when your medical expenses are likely to be much higher and more consequential than they are today. When you do pay for your healthcare costs out of pocket along the way, make sure you keep all the receipts for those qualified medical expenses. You can simply file those away and get reimbursements years down the road when the balance in your HSA is much, much bigger than it is today. In short, when we're constantly taking money out of our HSA to pay for little ticky-tack medical expenses, we're not allowing the HSA to do what it's designed to do, which is to build tax-free wealth so that somewhere down the road you can distribute it to pay for major medical expenses when you can least afford to do so. So by making a tiny tweak to the way you manage your HSA, all of a sudden you have this holy grail financial planning tool that gives you three supercharged tax benefits in one. In summary, we've always been told that you're either taxed on the seed or on the harvest. Well, with the HSA, you are taxed neither on the seed nor on the harvest. The problem is most people are taking constant distributions from their HSA accounts, which prevents them from tapping into the single greatest benefit it can offer, and that's unlimited tax-free growth between now and when you retire. If you would like some help implementing a balanced, comprehensive approach to tax-free retirement that shields you from the impact of higher taxes, head on over to davemcknight.com and click on the Connect with an Advisor button. I'm happy to refer you to an advisor in the Power Zero Network that has been trained, vetted, and qualified personally by me. If you're a financial professional and want to learn how to become a certified Power Zero advisor, head on over to powerzero.com and opt into my free video series. If you have any comments or questions, feel free to drop them into the comment section below. I'll respond to every single one of them personally. And don't forget to click like, subscribe, and the bell so you never miss a video. This is David McKnight. I look forward to seeing you on the next video.